Hi, I'm Mike Gassewitz, CEO of IAIC. Welcome to another episode of In Focus. Today we're going to talk about Silicon Valley Bank. Very timely, and we can imagine that folks are probably seeing what's happening south of the border and have lots of, maybe questions and concerns. And so joining me today is Joel Baker, our Chief Investment Officer. Joel, welcome.
Thank you, Mike.
Great to have you on. So, banks failing, it's happened before, and sadly it may happen again in the future, who knows. But so maybe we can first start off, in this case, Silicon Valley Bank, based in California, really focused at high-tech companies mainly in terms of providing banking services to these tech companies. Let's talk about the failure. Why, in a quick summary, what happened here in terms of what caused SVB to fail?
Yeah, thanks, Mike. That's a great question, and yeah, to your point, it's a lot of questions coming in from clients. So we just thought we'd sort of take a minute and sort of explain what we know. But in a nutshell, maybe I'll back up two steps. So there's a couple of moving parts to answer this question. So Silicon Bank really is a bank focused on just clients that are corporations and venture capitalists, and mainly just take deposits of those entities that are focused on technology. I know that sounds pretty basic, but it's not like our typical bank here where we're used to. So it's not like our Royal Banks where Joel and Mike walk in and deposit our paychecks and we take a car loan. So this is a very, very specific kind of bank. And at the end of the day, the clients make these deposits. The banks typically will offset those deposits by going to the bond market. So in this case, they bought U.S. Treasuries, they bought U.S. bonds to basically back those deposits. So for whatever reason, if clients or investors get nervous and they withdraw their monies from the bank, and let's just say everybody does it at once, the bank has to satisfy those withdrawal requests.
Right.
So the second part of this backing up procedure is we all sort of know what's happened in the bond market. And so we've done a few podcasts on this, and basically what when referring to as interest rates rose very, very quickly, bond prices fell very, very quickly. So you can sort of, imagine this, if the bank took on a lot of deposits during this low interest rate environment, they bought those same banks those bank bonds and those treasury bonds and so on and so forth that are down in value.
Right. Down to the point they're below the face value, correct?
Exactly. Yeah, exactly. So fast forward when those sort of investors got spooked, or depositors got spooked, I should say, and they sort of all withdrew their money at the same time, Silicon Bank was forced to sell off those bonds at losses. And let's just say this mismatch that I was referring to, their losses were such that the solvency question came up, that the bank was in trouble. So fast forward, that all happened in a short period of time and hit the headlines. And basically that's what the background to happening to Silicon Bank was. Now, the good news is that the regulators all stepped in and said, we'll back these. So the depositors are safe. So even though they're only insured the number was 250,000. The bank stepped in and said, no depositor is going to lose money. So basically they stepped in and were that financial backer, if you will, to provide some stability in short notice. So
good summary of what we saw. Again, a classic story of a run at the bank. As we all know, if tomorrow everyone showed up and wanted their money and pulled it out of the accounts, that's a run on the bank, and so that's what we're seeing here with Silicon Valley. So let's talk about our clients. Any direct effect with our clients?
Yeah, just a few points come to mind, Mike. So we had no direct investment in the banks. So no companies were bought in terms of their stock and client portfolio. So that's good news for sure. There will be a little bit of sentiment impact. I'll use that word sort of loosely, but everyone will probably get a little bit worried of financial companies, whether they're banks or insurance companies or just any financial company. So we'll see some volatility in the stock prices around the world, around the globe. However, our names are pretty safe, and we're kind of doing our homework here. It always seems like you can't do enough homework when something like this hits the headlines, but we're not seeing any disclosures being released in terms of banking relationships with the Silicon Bank or Signature Bank. So I think we're fine in terms of that. We will see some volatility. If there's any sort of good news that might come out is, back to this banks being too big to fail, maybe we'll see some depositors leave the Silicon examples and go to the big banks. So again, right, being big and diversified. The one downfall to Silicon was it was a very, very specific kind of bank. So, you could almost call it a one pillar bank, if you will. that it couldn't go to other divisions to raise capital.
Wasn't
So the
very
fact that
diversified, right?
exactly. So most of our names would fall into that. Specifically in Canada, we've got some big global diversified kind of companies that normally you could go to other divisions if you got into trouble like that. Because Silicon was a very focused bank, it couldn't. And so basically it could only go to the liability side of the balance sheet to sort of offset these, and that's what got it into trouble. So yeah, we're big, we're diversified, we're blue chip. So yeah, we're good in terms of that.
And if anything, the volatility may actually present some buying opportunities, because again, we always look at the fundamentals.
Absolutely. So yeah, that's one of the reasons we're scouring our banks as we speak, just to see which ones are maybe on sale today, just for that reason. Yep.
Right.
Exactly.
Joel, thanks for this. Very timely. Appreciate you jumping in and
Sure.
addressing any concerns of our clients. Folks, as always, if you have any questions, don't hesitate to reach out to your accounting firm financial advisor, or reach out to your portfolio manager. And as always, feel free to reach out to myself. Take care.